I think there are four things that are very interrelated in startup land. So Founders Fund took their, just to make the math simple, because I'm going to get the numbers not exactly right, but like a $2 billion fund that they're going to break into two $1 billion funds. So I think that's one story.
It's a $1.8 billion fund. They're going to break it into two $900 million funds. It's their eighth fund. It's being cut in half, and it'll become 8 and 9.
I think what that speaks to is valuations and the marks that we think we have for our existing companies and the future value that smart investors like this see. All roads lead to, we're in for a slog. And so trying to put a $2 billion fund to work doesn't seem to make a lot of economic sense to some of the smartest people in the room. So that's that. The second thing is,
it says, according to Axios, Peter Thiel led this charge, and he is the contrarian's contrarian. He was the one, according to Axios, that led that cut of the fund size with some at Founders Fund, according to the reports, opposing him.
I'll say the more important thing, which Peter and I are in the same, we're the largest LPs in our funds. And so, as the largest LPs in our funds, I think this is a no-brainer decision. Number two, Stripe basically takes a 50% haircut, which is the single best run, most highly valued company in Silicon Valley. Again, that's going to eviscerate
private company. Yeah.
A lot of TVPI in a lot of people's portfolios, a lot of theoretical money that LPs were going to get. I think the third thing is there's a person that went and filed a FOIA request at UC Berkeley to get Sequoia's returns. And it turns out that the best investor in the game, quote unquote, since 2018 has not really done that well. And I think in the University of California invested over $800 million in Sequoia since 2018, and I think has returned, some $40 million on that number. And then the fourth, which just came out today, is that Tiger wrote down the value of their private book by 33%. For 2022. And so, I think Tiger's AUM basically has gone from 100 billion to 50 billion in a year.
There's one more note to add to that. YC basically let go of their growth team this week. Y Combinator, for people who didn't know, had what was called the Continuity Fund. They were doing late stage investing, and that got cut.
Gosh.
Which is a signal, and the 17 employees are gone now. And Gary Tan, I think, is making the right decision. They have to focus on what they're great at, which is the earliest stage of the company, and they had conflicts with this one.
Look, This is the most interesting thing for me in the following way. I think the Y Combinator unicorn hit rate is 6%, right? So every 100 companies that come out of YC, which costs only about $10 million to seed, right? 6 of them become worth $1 billion or more. And obviously some become worth much, much more. And so if you see how difficult it is, even for a growth fund that's attached to that funnel, to be successful and make money, because obviously if this thing was tonning cash, you would not have cut it. I don't think anybody would do that. So I think it was a very challenging strategy at a challenging moment in time. And so I applaud these guys for having the discipline to do it. But if you take them all in totality, it is a complicated place in venture capital and startup land. Holy mackerel.
It's a reset.
A, it's tough to make money. B, a lot of folks may not know exactly what they're doing. C, a bunch of valuations are totally wrong. And D, we're going to have to start doing the cleanup work now of resetting all of it, which just takes years, as you guys remember in 2000. It took us 5 years to fix this.
Yeah, it's a hard reset. Sachs, what do you, when you look at these in totality, what would you say?
Well, I agree with what Chamath just said. I mean, it is going to be a hard period with a lot of resets, a lot of restructuring, a lot of cap tables. There's a lot of mess to clean up. All of that being said, I think I'd rather be an investor today than an investor 2 years ago or 1 year ago, because at least the valuations have corrected to some degree. And then also we have this really interesting AI wave happening now, and there's a lot of opportunities to invest in that new, cycle. So at least there's an interesting product cycle. It's getting me excited to go to work and see these new demos from all these different companies. Whereas, you go back a year or two and just the product innovation just didn't seem as world changing as it does now. So I think that as bad as things are, my guess is that the new vintages of VC are going to be better than, call it 2021 for sure.
That's not going to be a high bar.
It's not a high bar, but still.
Well,
That
But that's the
vintage
thing.
is
But
trash.
actually, Chamath, this is the
That vintage is
contradiction.
trash.
This is the contradiction, is that it felt better to be a VC in 2021. But in hindsight, we know that the vintage is going to be not good. Whereas
David,
today, hold on, but today it feels not great to be a VC, but I think the vintages will be a lot better.
But anybody would tell you that at some point you're going to have to divorce yourself from emotion to be a reasonably good investor over long periods of time. How many data points do we need to realize that too many people were put into this game that may not have known what they were doing? And we're going to have to go and work through all of those excesses. And I think it's just going to take a lot of time. US limited partners are in a really difficult spot. European investors, I think, are probably in a pretty difficult spot. There are a couple of bright points around the world of folks that are still optimistic and doing well. I think Middle East is one. Southeast Asia is another. But other than those, it's just a whole group of folks that just have to get completely re-underwritten from first principles. Even when you have an incredible platform like Sequoia, 5 years of no returns on $800 billion for somebody like UC Berkeley. What it really means, without commenting on Sequoia's performance, is that UC Berkeley is effectively out of business in being a limited partner for the foreseeable future.
well,
Right? And I think that has implications. So even if you think these vintages are great, I don't think they're open for business. And frankly, even if they wanted to be open for business, how do you go to an IC when they look at all of the totality of those dollars that have not made anything? How do you justify the next 800 billion? I just think it's very hard.
While I agree that LPs are out of it, I think the story was garbage because all funds go through a J curve, and they're literally talking about the majority of the funds in that vintage, 2008, 2019, 2020, 21, they're all in literally the definition of the J curve, the third, fourth, fifth year.
One of the most important things you need to be able to do is measure how long does it take the delta T to 90% of calling committed capital, and how long does it take the delta T to return 1x DPI? I can tell you, Jason, if you're a reasonably good fund, those numbers should be between 5 and 7 years for both.
Which none of those funds have hit.
The average for a normal venture fund is around 5 to 7 years to call 90% of the capital and around 5 to 7 years to return 1x DPI. I'm just telling you that's what the average is. And if you talk to firms, so all I'm saying is there was a period of time where, in the absence of getting money back, again, this is not a Sequoia thing.
Yeah.
It just means that there was an entire cohort and years of capital allocation that is not necessarily in a J curve, it's impaired. Because if after 5 years if after 5 years you've returned nothing, sometimes you just have to see the writing on the wall.